This is Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Oil and gas prices surge as Iran and Israel trade strikes on key Middle East LNG facilities. Tehran saying energy sites across the Gulf are now legitimate targets.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Well, the Fed holds and continues to flag one rate cut this year, even while raising its inflation outlook. Traders aren't buying it, trimming their bets on any easing. Asian stocks are set for declines after the S&P 500's worst Fed day since 2024. And surging oil prices also in focus for the Bank of Japan as traders await clues on future hikes and a hold expected today.
Yeah, all 51 economists surveyed by Bloomberg expecting that hold to come from the Bank of Japan. But of course, it's really those clues when it comes to the inflation outlook and what the BOJ will do in order to really support the economy, which will be key in today's press conference by Governor Ueda. We are seeing Nikkei futures at the moment under a little bit of pressure after we saw those gains in the last session. We're also seeing a little bit of strength for the Japanese yen against the greenback. Of course, the Japanese yen and the weakness that we continue to see there is a key issue for the Bank of Japan. This at a time when we're also, of course, expecting Prime Minister Takaichi to meet with President Trump tonight in the United States. So we'll be watching for any headlines around support on the Iran war. And we're watching the staggered open at the ASX 200. Do watch out for the Aussie dollar. Of course, we had a little bit of a mixed picture for the dollar, but after the hawkish messaging coming from the Federal Reserve, we'll be watching for those repercussions in the FX space. The Kospi had already gained to highs that we haven't seen in about a month. We could see some more downside pressure, especially in the tech sector, Haidi, because we have also heard from Micron. Yes, their revenue outlook beat estimates, but it's always the concern around capital spending.
There's a lot of concerns overall, particularly when it comes to how central banks navigate the path from here, right? Take a look at what we're watching when it comes to that muted session overnight. It wasn't a great reaction to the Fed, of course, and we're seeing that softness in US equity futures as well. A little bit lower when it comes to WTI as well, off the overnight highs that we saw. Treasuries, we also saw being sold off across a curve on Wednesday. Yields are being pushed higher. We're lifting the dollar as well after we heard from Jay Powell about just the fresh uncertainty that we continue to see from the Iran-Middle East conflict situation. But take a listen to the Fed chair when he tries to characterize what he's seeing when it comes to the progress on inflation.
The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress.
Let's bring Garth Reynolds, who leads our Markets Live Asia coverage. What stood out to you from hearing from Chair Powell?
Well, I thought it was quite extraordinary that they were so focusing on tariffs still. It seemed like yesterday's story. Especially considering that one of the things that maybe people haven't been paying so much attention to the last little while is that the Trump administration is still pushing ahead with trying to reinstate the tariffs that the Supreme Court has struck down. So with that being the case, will the tariff situation do much to take the edge off inflation? Doesn't really look like it, and that's almost certainly going to be overwhelmed by what's happening in the Persian Gulf. And also, we had a PPI reading that was showing a pickup in cost pressures from there. So it was a little bit discordant, the tariff focus, but the message that still came through was they are worried about inflation. And we've seen with the RBA this week what happens when a central bank becomes worried about inflation.
And what did the updated dot plot tell us? Because there's also the issue of the weakening labor market, right?
Yes, so again, the updated dot plot did lean towards that concern about inflation. It was a little bit less instinctively accommodative. Board FOMC members clearly remain concerned about what's going on with jobs. that's there, that's part of the baseline, but the other part of the baseline is what's going on with inflation, and the inflation concerns have clearly ticked up. So I would argue it offers more potential, even just the current setup, that the Fed remains on hold, for longer, and doesn't even sort of move towards accommodation until they can be sure the war is in the rearview mirror. The other thing about that was that in the press conference, Powell kind of indicated that you don't want to regard the dot plot as in any way set in stone, sort of even more than usual, because it just doesn't take into account what's going to happen because of the war, because they don't know yet. So I don't think the dot plot gave much comfort to anybody who was looking for the Fed to help out the US economy in the short term.
There's a new angle when it comes to the oil worries, right? Because even if we see the war ending tomorrow, the Strait of Hormuz being opened up again, the risk now from these damaged energy assets across the region is starting to play out.
Yes, very much so. And it's one of the things that markets are having some extra difficulty in pricing, at least on the surface of it, because this isn't really about oil. There's one part of the oil market that is showing the tension. That's the way that Brent is showing a greater premium to WTI, because Brent is the international barrel, whereas WTI is for internal US. But the real problem is the gas facilities, like LNG. Qatar has had damage to its refinery, which accounts for something like 20% in the normal case of things of global supplies of LNG. And there are no strategic reserves of LNG. And Asia, especially Korea, but also Japan, has been very dependent on Middle Eastern supplies of LNG. And then alongside that, there's the fertilizer, which a lot of the fertilizer production, again, comes from LNG being used to produce fertilizer. So those impacts are going to do economic damage and cost pressure increases globally, and especially in Asia. And yes, that's not something you can switch back on, even if you could magically reopen the Strait of Hormuz.
Garfield Van also leads our Markets Live Asia coverage there as we continue to watch the Middle East developments. One reason why the Bank of Japan is also widely expected to keep its benchmark rate unchanged later today. We continue to see soaring oil prices, of course, and that's going to complicate the bank's efforts to reach that 2% inflation target at a time when, on the other hand, you also have a weakening Japanese yen, very close to that 160 level. For more, let's bring in our economy and government reporter Yoshiaki Nohara. Yoshi, so we weren't necessarily expecting the BOJ to move, but we're thinking that perhaps if it doesn't, that we could see more pressure on the Japanese yen. But given what's happening in the Middle East, is that sort of a good justification for the BOJ to be like, look, nobody can move at this point? I wonder if that will actually help with the yen as well.
Well, that's a really good question, Shery. So the consensus is that no move, no rate hike this time. But it's all about Governor Ueda's and also board's messaging about the situation, about two main things. One is how they assess the wage negotiations early results, which sounds really good. But at the same time, they have to assess the big unknown, which is about how the Middle East situation is going to affect the Japanese economy, not just inflation, but the economy, because the inflation is likely to be supported by higher oil, but that's not good for growth. So it's a very difficult balance that the Governor Ueda has to navigate, when he tries to communicate its stance to the markets today.
When it comes to domestic drivers, if we set aside the global reflation story, how are things like household confidence, spending, wage growth going?
Heidi, there was a public poll taken about how much people are worried about the potential impact, economic impact of the war in Iran. And many people do brace for some kind of impact because they know that how Japan is dependent on oil imports from the region, and also that's going to affect their daily spending, such as gasoline prices, which is Prime Minister Takaichi is trying to keep a tab on so hard. So, there's a big question how this inflation push coming from the higher oil is gonna square with the momentum that Japan was trying to secure to make sure that this inflation is happening in a positive way, happening with the strong wage growth. That scenario is pushed into a big question mark right now.
Bloomberg economy and government reporter Yoshiaki Nohara, and of course that question mark really to do with the ongoing tensions in the Middle East. Iran and Israel have traded strikes on key energy facilities in the Middle East, complicating U.S. efforts to calm energy markets. U.S. National Intelligence Director Tulsi Gabbard has told lawmakers that the regime in Iran appears intact despite U.S. and Israeli attacks.
The IC assesses the regime in Iran appears to be intact but largely degraded due to attacks on its leadership and military capabilities. Its conventional military power projection capabilities have largely been destroyed, leaving limited options.
Let's bring in Bloomberg Politics editor Laura Davison. Limited options for Iran is the narrative in Washington, but what are we seeing actually on the ground?
So on the ground, we see, Iran really going on the offensive today, striking a bunch of energy sites in the region. We had several announcements of, both in Qatar and Abu Dhabi of sites that have either been damaged or are going to go offline because they've been damaged or there's concerns about continuing to operate them. That continues to just put pressure on energy prices. We really saw that. I've seen that in the market over the past 24 hours or so of, oil, hitting near $110. This is a real uptick. Prices had been elevated but stable-ish for some days, and now we're starting to see that worry really creep in as central banks too are also starting to come out with their decisions. Hearing, a more modest, more moderated tone from them on not sure exactly what the long-term outlook is like, but from what we're seeing just happening day to day on the ground of increasing uncertainty and more sites that just simply aren't able to produce anymore.
French President Macron speaking right now, saying that he spoke with President Trump, that the Qatar Emir as well, about the Iran strikes, and that he's calling for a moratorium on strikes aimed at civilian assets. What are we seeing from allies? What are we seeing also from other countries in the Middle East?
Yeah, we're seeing a lot of disagreement. Israel has sort of been the most aggressive on this front of, looking to go after some of these sites. Trump has sort of had an evolving position, shall we say, of, he originally, especially Carlyle is a perfect example. Let's go after military sites, not necessarily energy sites, but he sort of said, well, maybe I would, but I don't want to. And so this is where we're seeing a lot of tension of, to do some of the military things that Israel seems more inclined to do that would, would really damage the regime, would also really damage energy infrastructure and have a lot of ripple effects globally, economically. And so you're seeing concerns that, both you have civilians as well as, civilians in Iran and civilians around the world who would face both the economic and, in the case of Iran, life-threatening consequences with some of these more extreme attacks.
Laura, we just have a line crossing the Bloomberg, and it's quite interesting. The Washington Post reporting that the Pentagon has asked the White House to approve some $200 billion request to Congress in relation to funding this war. What do you make of this, the chances of this going through, given what we know about how public support looks and how support or lack of support from the Democrats might look too?
This is a huge number. I don't know, they have the exact numbers of what the current military budget is in front of me, but this is something, like 20 or 25% of the military's annual budget. So this represents a huge increase. And it's sort of an acknowledgement from the Pentagon that they see this as a very wide scope on this war that potentially lasting for a long time for a $200 billion request from Congress. This is going to be a really, really tough sell in Congress. You have Democrats who are essentially unilaterally opposed. In the Senate, you need some Democratic support to get these funding bills through, and also a lot of Republicans who have long talked about, cutting government waste. Just a year ago, it was all DOGE and how do we shrink the size of the federal government. Now essentially having a huge expansion of government spending will be politically difficult. The White House in this report is sort of acknowledging that this is going to be a really hard sell, and so they're looking to sort of how they can pare this back. But going from $200 billion to a number that both the Pentagon can agree on and members of Congress, that's going to be a very difficult negotiation that could take weeks, if not months.
Washington completely distracted right now because of the Iran war. And we have Prime Minister of Japan, Takaichi, in the U.S. We're now hearing that the summit between President Trump and Takaichi, that meeting will be held at 11:15 a.m. Eastern on Thursday. That's tonight. That's going to be tough.
There's a lot going on. I mean, essentially, around almost midnight Tokyo time, they'll go into the Oval Office, they'll sit down, and this is going to be a day that's not particularly great for Trump. Especially he's been very attuned to oil prices. Oil prices are high and rising. This is going to be difficult. Even the administration has not had a lot of options that they've tried to pull. They waived the Jones Act, which is this century-old law that allows ships to move more freely and transport energy commodities around U.S. ports. That only will have a minimal effect to what we've just seen happen today in the Middle East. So Trump is going to go into this meeting not in a particularly good mood. Takaichi even teased that yesterday, saying that this will be an extremely difficult meeting with the president. Meanwhile, she is not in favor of this war. She's indicated in many different ways that Japan will not be sending resources to help support this, and that Japan has a lot of concerns. That has really been Trump's main focus the past week of how to get allies on board. He's unlikely to get that up Takaichi today.
Yeah, the Japanese public hasn't been very supportive of this war. So we'll see what actually comes out of these meetings. Laura Davison here in the Tokyo studio. She's our Bloomberg Politics editor. Of course, we have plenty more coming up on the Asia trade together with, of course, a very, very busy news flow. We also have AIA Group CFO Garth Jones joining us next. The insurer now reporting earnings and a $1.7 billion buyback. Now, we get the BOJ rate outlook with former board member Sayuri Shirai. Plus, we also have a research on China's tech sector. This as Tencent is now flagging a big increase in AI spending. Much more ahead. This is Bloomberg.
Well, Hong Kong-listed insurer AIA Group has reported an increase of 17% in new business value on an actual exchange rate basis. They've also announced a stock buyback worth $1.7 billion. Let's get more on these numbers. Let's bring in Garth Jones as the AIA Group CFO. Garth, always great to chat with you. Appreciate your time today on earnings day. But I wanted to start off with the broader macroeconomic and geopolitical environment. Can you tell us if there's any impact or exposure that you're seeing from your business?
Yeah, thank you, Heidi. Always great to be here. Our business is a very long-term business, and it plays to the real needs of people. So we see fluctuations in markets. We see sentiment shift from positive to negative. What we continue to see through the cycles is a strong demand for our products and services because they meet the real needs of people. Our protection and long-term savings products really go to the heart of what people need for their retirement, to protect them for their health care and so on. So we still see continued demand. You see that demand coming through in the very strongly excellent results we've posted today. We see good momentum in the business, and we're very confident about the future.
And there's also, of course, private credit as an area to worry about as well. Does the business have any exposure there?
We have a very small exposure. It's about 2% of our assets are invested in private credit. The investment is with the big private credit investor companies. What we see is that the majority of that investment is in senior structured direct lending. We think it's a very attractive asset class if managed very properly. Obviously, we have a very disciplined investment function. We're very focused on credit risk in particular and look through all our exposures. We're very comfortable with our exposure, and as I say, 2% of the overall portfolio of assets.
When you have another war raging in Iran and you have more uncertainty about where global rates are headed, and there seems to be a sort of a narrative that those rate cuts might get delayed, what is the impact when it comes to the uptake of your products and demand out there? Because a lot of these products could also potentially compete with other financial goods out there with high bond yields now being a norm.
Yeah, our products are long-term, and with that, they move through cycles. What we have is products that meet the long-term savings needs through a variety of investments. Our stewardship of those assets is very careful. People can be confident that we'll provide good returns to our customers and be there when we need to be there. What we see is that demand comes through into the sales volumes. You saw good growth in volumes. We see that the business is in great shape. We see that the alternatives that are available are still there, but that demand for our products continues through the cycles. And that's really the message that I wanted to get across this morning, is that ours is a long-term business. We see fluctuations from time to time. Clearly on the balance sheet side, we have a very disciplined asset liability management. And we update our products regularly to meet the varying needs of customers as they evolve, particularly for the long-term pensions products. So with that, we continue to see the demand coming. We see the momentum in the business, and we can see that the track record that we have over many years is continuing. And that track record has been built through cycles. We've seen interest rates shift, we've seen curves shift, but that demand continues throughout.
Many Asian economies, of course, are energy importers. Do you see any of that macro stress coming from the Iran crisis leading to some downside pressure? And what are your expectations for that positive momentum that you talked about to actually continue into the uncertainties of this year?
Yeah, from a balance sheet perspective, we have a very strong asset liability management, as I said. We have a very strong balance sheet, so from that perspective, we're very secure. From a demand perspective and a growth perspective, we see that the technology that we've used, that we've implemented, has increased the productivity of the agency force, which is 73% of our sales are through the agency force. You saw that grow 13% last year. You see that the partnership business through banks and brokers grew by 22%. What we have is a situation where the fundamental structural drivers of our growth in Asia are still intact. The consumer, the affluent consumer, still has funds, and we see our products as a long-term savings products as a good place to stewardship those funds for good returns to customers. People also have protection needs on a continuing basis, regardless of the macroeconomic environment. So again, good demand, and on the supply side, we see good supply. Our agent recruitment is very strong, and with that, we can see that the sales momentum is very good.
Garth, always great to chat with you. Garth Jones, AIA Group CFO there. More ahead on the Asia trade. This is Bloomberg. Take a look at some of the movers that we're watching so far in the Aussie session. We're about almost half an hour into the start of cash trading when we are seeing a bit of a bifurcated picture there. Some of those energy names, the ones that have really benefited from this surge in oil prices, Woodside Energy, Santos continuing seeing gains. Some of the threats over the LNG infrastructure in the Middle East, we're going to have implications for LNG-related names in this part of the world as well. We are also watching some of the leadership-related changes as well. Of course, we heard that on Woodside as well as BHP Group there as well. BHP's next leader really looking like he's going to face quite a lot of challenges, particularly when it comes to M&A across the business and some of the rebalancing of BHP's portfolio towards copper and away from iron ore. Rio Tinto seeing downside of about 2% at the moment. What will be quite interesting to see how sustained these gains across energy names will be. We had Citibank Wealth saying that in the US, that energy stock rally is likely to peter out, but at the moment, Aussie energy shares continuing to rally. This is Bloomberg.
Take a look at how Japanese assets are setting up for the market opens. Of course, we have seen a little bit of more strength for the Japanese yen against the US dollar, and this as we are headed towards a Bank of Japan policy decision. No change expected by the BOJ, but we'll be watching, of course, those clues around the inflationary outlook and whether that could lead to the BOJ to act sooner rather than later. Perhaps April is a key question, as you have the yen trading very close to that 160 level that's already seen as that threshold for intervention. So we are again on intervention watch. We have already heard from the Finance Minister Katayama saying that authorities are looking very closely at FX moves at a time when we're also watching very closely that Takaichi Trump summit in the United States tonight. Take a look at Nikkei futures down more than 2% at the moment. But let's discuss what we can expect from the BOJ. Sayuri Shirai, she's professor of economics at Keio University and previously served as a board member at the Bank of Japan. Sayuri, always great to get you on BOJ Day. There was really not much expectation of a rate move by the BOJ at this meeting. But I wonder, given that we do have the chaos around the Middle East and, of course, oil prices surging, if this will give a little bit more justification for the BOJ to hold, despite a little bit of more strength when it comes to wages and the broader economy.
Yeah, I think dilemma faced by Bank of Japan is even more strengthened because inflation was coming down. Actually, in January, inflation was dropped to 1.5, below 2%, and thanks to that, the real wage turned into the positive. So I think BOJ expected inflation will stay below 2% for a while. And then toward the end of this year, the economy recovery pick up. So inflation starts to go up again to reflect the rising demand. But this scenario is no longer valid. So BOJ really have to check, their scenario is still makes sense. And then next April meeting, they are going to show the new projection.
The Shinto wage negotiations also seem to have gone well with people getting big pay bumps this year as well. If the BOJ has been saying that it was about wage growth and also inflation dynamics, and you have that cost inflation because of oil prices, wouldn't this be the right time to act sooner rather than later?
So if this Middle East issue didn't happen, it was possible for BOJ to raise interest rate in April. But now, in the past 2 years, the Shinto, wage negotiation led to the 5% increase in wages. But this is only among large companies. If you include small, medium enterprises, the wage growth was a little above 2%. So small, medium enterprises very slow to adjust in terms of wage hike. And now, because of this, Middle East issue, and we depend so much on Middle East oil and naphtha, so I think it's a bit more stagflationary. So BOJ have to be a bit more careful in terms of raising interest rate. Also, yen's depreciation is the biggest concern.
How fragile is that sentiment when it comes to business sentiment, when it comes to the strength of the virtuous cycle?
Yeah, so BOJ always says there is a virtuous cycle from wage to prices, but to be honest, that hasn't happened because many companies say they raise wages because living costs are much higher and the serious labor shortage force them to raise wages defensively. So it's not really virtuous cycle. But if inflation has stayed low, it was possible that real wages finally starts to go increase and stay there. But I think now, let's see what will happen to this oil price. Gasoline prices are already much higher now, so it's not going to be the same story.
When it comes to the yen, has tolerance in terms of a higher ceiling or a lower ceiling, I guess you can say, when it comes to yen weakness, has that shifted?
Yeah, this is a dangerous zone now. So it's now nearly 160. I think today, after Governor Ueda's meeting, during meeting, people are really paying attention to what he will say. Remember in the previous meeting, January 23rd, only yen was depreciating sharply, right? Reflecting Takaichi-san's view, expansionary fiscal policy, etc. So yen was depreciating, and during the press conference, Ueda mentioned that he's not going to, raise interest rate anytime soon. So such kind of a dovish, the remark led to the sharp depreciation yen to nearly 160. And then there was a rumor about New York Fed rate check, right? Led by U.S. Treasury. So thanks to that, yen started to appreciate. But this time, it's not the Japan's issue, right? It's a U.S. dollar strength. So it's very unlikely that the U.S. New York Fed will do the rate check this time. So it's more challenging for Japan in terms of yen's depreciation.
President Trump doesn't necessarily care about all of those macroeconomic dynamics, and he's probably in a very bad mood right now because of things around Iran. What are the risks going into that summit? Because I remember just a couple of years ago, too, before President Trump became very friendly with Prime Minister Takaichi, he did not like weakness in the Japanese yen.
Yeah, so yes. So he doesn't like yen's depreciation, and also Bessent also say Bank of Japan should raise interest rate, so certainly true. But at this moment, I think U.S. understand this, strength of U.S. dollar and the depreciation of Japanese yen together with Korean won is related to Middle East and our excessive dependence on Middle East. So I think issue will be not exchange rate this time at the White House meeting on the U.S. time today. It's more about security issue, I think.
How much is it of a domestic political issue for Prime Minister Takaichi as well, given that the Japanese public is not very happy with the Iran war at a time when household living costs are also going up? Does a macroeconomic situation present a risk for Prime Minister Takaichi?
Yes and no, because she abolished some kind of gasoline tax at the end of last year. Thanks to that, the gasoline prices dropped by 25 yen. But now, because of this Middle East issue, the gasoline prices went back. And so, thanks to this tax cut, gasoline prices are much better than, what would have happened. So in that sense, we cannot really, put a lot of pressure to her. I think, it's more issue is, how we move away from Middle East dependence, and then probably we will put more investment in U.S. Oil and gas. And so that will be discussed. And I think public is a bit more worried about conflict side in Middle East.
Sayuri, Shirai, always great to have you with us, Professor of Economics at Keio University. Let's take a look at the picture that is, of course, confounding so many policymakers. That'll be top of mind for the Bank of Japan when it comes to this stagflationary risk, and it is what we're watching when it comes to oil prices. Again, we're seeing really the way up for not just, of course, we're seeing Brent crude seeing kind of the bulk of those gains, which of course impacts economies in Asia more so than the New York traded crude, which is still seeing some gains, but a little bit less of that momentum. Natural gas futures also up by 4% as we continue to see now extensive damage being reported from Qatar at the world's largest LNG plant. So the Qatari complex housing that LNG gas export plant seeing extensive damage after a missile strike. It's really another escalation in hostilities across the region, but also really presents this idea that as we get energy infrastructure being targeted in the Middle East, that could be a longer lasting sort of damage than even potentially seeing the Strait of Hormuz being reopened. Well, the Carlyle Group's Jeff Currie says oil markets have not fully priced in the supply shock from the war in Iran. He also told us that the lifting of sanctions on Russian crude will support the surge in Brent and WTI.
The bigger factor that was likely driving WTI and Brent and staying lower is the price of Urals, Russian crude oil. It's rallied $65, $70 a barrel once they took off the sanctions. So WTI and Brent were the high-cost barrels. The Russian was the cheap. What happened? You closed that gap. And now that you've closed that gap, you don't have any more spare barrels in the system, and this rest of the complex likely to start to rally. I go back to the point that, John started with is, we're dealing with an enormous supply shock. By the way, the supply shock is almost equal to the demand shock during COVID. And we know what that did to global supply chains. So I think, at $100 a barrel, this thing's mispriced, even against the physical market.
There is a sense, though, that this time is a bit different than, say, the 1970s in terms of the world's reliance on oil, especially China, how much they've diversified to electric vehicles, to nuclear energy, and other places as well. How much do you think that that is going to be the growing trend, to diversify the sources of energy in myriad ways beyond what we were doing, even during the so-called Green Revolution, as people try to avoid these types of shocks?
Well, I absolutely argue that, the renewables, nuclear power are born out of the 1973 energy crisis. And this is going to unleash an enormous amount of investment into renewables, nuclear power, and other localized energy sources. The problem, though, is we call this the new dual order. The problem is that we haven't got to that transition where we have electrified everything, localized it. And the type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table. Or you go from LPGs to synthetic fibers to cotton. You switch out of soybeans and corn into cotton. By the way, I think the best sector to try to get value in right now would be agriculture because it hasn't priced it in.
Jeff, when it comes to barrels coming off the market, this came from an industry consultant in terms of China. They're looking at potentially a drawdown in commercial and operational stockpiles amounting to as much as 1 million barrels a day. That can happen over the next 4 to 6 weeks. What would that mean for the price of crude?
I think the key point is once you exhaust those inventories, there's nothing left. Think about it this way. You have demand up here, supply down here. Once those inventories are exhausted, boom, you have to bring demand down in line with supply.
Carlyle Chief Energy Strategist Jeff Currie there speaking to Bloomberg Surveillance. The top global headlines we're following. India is sending additional warships to the Middle East to ensure the safe passage of its vessels in anticipation that Iran may allow more of its fuel tankers to exit the Strait of Hormuz. Sources have told Bloomberg that the Indian Navy is deploying over half a dozen warships as a precautionary measure. Their mission will be to escort vessels until they reach safer waters in the northern Arabian Sea. China's military is said to be studying President Trump's war in Iran for lessons that could be helpful in any future conflict of its own. Western officials have told Bloomberg that Beijing is gaining valuable information from America's military performance in Iran that would factor into plans for potential conflict over Taiwan. China's Ministry of Defense did not reply to a request for comment. More ahead on the Asia trade, this is Bloomberg.
Micron shares fell in after-hours trading after the largest U.S. maker of computer memory chips warned that it will need to spend heavily on production to meet burgeoning demand. Let's bring in Bloomberg Asia Equities reporter Yu-Kyung Lee for the latest from New York. So, Yu-Kyung, I mean, the forecast was pretty upbeat. Demand seems to be good, but so many concerns around the costs.
Absolutely. Yeah, I think that's exactly why the shares are falling right now. Investors seem to be really concerned that Micron is spending heavily on its capital expenditures, and this was giving the forecast that in 2020, this fiscal year through August, it will be spending $25 billion, which is more than what analysts expected at around $22 billion. Micron also said its 2027 expenditures will increase more than $10 billion from the prior year. So that's been adding pressure to the Micron shares. I think another reason that now investors are concerned is that Micron gave really strong forecast for the third quarter gross margin at 81%. It's like a dreamlike figure for a manufacturing company to have a gross margin of 81% for the quarter, but there are concerns that this might be a peak. Its margin growth going above 81% is going to be really challenging. So there's also concern about the peak gross margin that's also weighing on the Micron shares.
Do we have a good consensus on how long the global shortage might last for and continue to impact these sales projections?
So global shortage on the memory chips going to last for a while. That's not any concern for investors I've been meeting and talking to in New York. I've been asking a lot of investors about how much they're concerned about the potential memory price going to a downturn, and there were no investors who were concerned. Is the supply shortage is going to last for a really long while, and Micron's spending also seems to be showing that it's confident that supply shortage is going to last for a while, and that's why the company is spending heavily on its capital expenditure. So we could see that from its blowout earnings quarterly earnings results.
Bloomberg Asia Equities reporter Yu-Kyung Lee there joining us from New York. And given Micron's results, of course, we'll be watching some of those stocks in South Korea, especially SK Hynix and Samsung Electronics. According to Bloomberg Intelligence, their memory business could post gross margins of up to 80% in the first quarter and then up to 85% in the second quarter based on Micron's strong results. But do watch out for some potentially negative news. Samsung's labor union members have voted in favor of a strike and threatened a general strike to come in May. Haidi?
Shery, Tencent's ADRs in the US session fell. Despite earnings coming in line with estimates, the company plans to at least double investments in AI to more than $5 billion in 2026. It's bringing our China correspondent Movement Low in Hong Kong. So apparently that wasn't enough for investors.
Yeah, the bar has been really high, and it's just getting increasingly difficult to impress investors because Tencent did report very solid set of earnings, double-digit gains for the fifth consecutive quarter, 13% gain in revenue that is boosted largely by its main cash cow, which is the gaming segment, particularly its international gaming unit, which grew at a faster clip as well. But of course, a lot of attention is on its AI developments, right? The company said it's going to raise AI spending by 2 times this year. And last year, it said it spent 18 billion yuan in its large language foundational model in its ChatGPT-like app called Yuanbao. So this year, that means AI spending would be lifted to at least 36 billion yuan, but that still pales in comparison with the sort of AI spending we're seeing from the likes of Alibaba. And in addition, I think there has been a lack of clarity from the executives at the earnings call yesterday in terms of what sort of investment targets, what products are they going to be investing on, what sort of talent acquisition targets, and there's just not enough to whet the appetite of investors. And at the same time, it's also facing increasing pressure, not just from the likes of Alibaba, particularly when it comes to cloud computing. You can look at the stock, it's been lagging behind Alibaba for the past, since the start of the year. But Alibaba is the major leader when it comes to cloud computing, so that's a weak point for Tencent. But again, all eyes are going to be how it's going to roll out its own agentic AI service, which company executives did not provide a timeline for as well.
Yeah, when it comes to Alibaba, we actually saw them raise their AI computing cost, right? So what are we expecting from today's earnings as well?
Yes, so Alibaba has 2 main business segments, right? One is the e-commerce side and the other is the cloud computing. So e-commerce, we are expecting to see a profit drag just because it's been spending a lot on promotions. It's expanding into the quick commerce category, battling with Meituan. So we might see a bit of a profit squeeze there, although it might be better than the first half of 2025. We saw a big drop in its e-commerce business growth because of that price war. But when it comes to AI, as you said, Alibaba has been one of the most aggressive spenders, and now it's announcing price hikes as much as 34% that might quell some concerns around the sustainability of its investment. The company also just went through a major revamp, bringing all its AI products and services under one umbrella. But again, Alibaba, while it's a leader in large language model making, it still struggles to monetize, and it doesn't have the superpower that Tencent has, which is the WeChat app, which is so ubiquitous in China. And that's why Tencent is still seen as best positioned to capture this AI agent craze. But Alibaba will have to prove to investors how it's going to be able to monetize the huge amount of investment. We're also looking out for whether the company will revise upwards its capex spending as well.
Bloomberg China correspondent Min Lo there with the latest on those Chinese tech giant results. You can get more on the biggest stories in the tech sector on the Bloomberg Video Hub. You can also check out past episodes of Bloomberg Tech Asia and other shows on Bloomberg.com/videos. And here's some breaking news out of Japan. We are getting the core machine orders month-on-month and year-on-year, both decelerating from the previous month. When it comes to month-on-month numbers, we're seeing a contraction of 5.5% for the month of January. Still a little bit better than economists had expected. The year-on-year number is still in expansion territory, growth of 13.7%. And better than economists had expected. Both numbers still a deceleration from the previous month. These core machine orders have been a little bit volatile in the past year, but the data coming on, of course, BOJ Day when no change is expected on the rate. We have more ahead on the Asia trade. This is Bloomberg.
Let's bring you up to date with the latest on private credit. And S&P Global Ratings has lowered its outlook on Cliffwater's flagship private credit fund to negative from stable, citing elevated redemption requests that threaten its liquidity. The fund plans to meet 7% of withdrawal requests in the first quarter, higher than the 5% minimum. S&P says it views the 5% cap as an important guardrail. PIMCO's president says the investment firm is staying away from loans being put up for sale and outflows from private credit markets. Christian Stryker told us that the prices being asked for the assets are still too high given the risk, and PIMCO would need to see high teens returns to become interested.
A lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them.
This is a setup across Asia. We are seeing a little bit of downside pressure when it comes to the futures setup, with Nikkei futures down more than 2.5% after gains in the previous session. We are seeing a little bit of strength for the Japanese yen against the US dollar ahead of the Bank of Japan policy decision, where 51 economists surveyed by Bloomberg don't expect a change. 37%, though, do expect a hike in April. And we continue to watch economic data out of Japan. Wage growth remaining strong, so the Shunto wage negotiations seem to have given a good pay bump to Japanese workers. And you can see the Kospi futures down more than 3.5%. Do watch out for the likes of Samsung, SK Hynix, for example, Hanmi as well, that gets about 20% of their revenues from Micron, which had strong results, but at the same time got hit because of concerns about capex. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after we saw the worst Fed day for U.S. markets since 2024. That hawkish messaging coming from Chair Powell, Haidi, when it comes to, of course, inflation expectations on surging oil prices because of geopolitical tensions at a time when today here in Japan is also BOJ Day.
It's a real concern, particularly now through the veil of what happens to these damaged energy assets across the Middle East, right? As they start to be really the serious targets for strikes across the region, that's going to take a lot more difficulty in terms of coming back online than just reopening the Strait of Hormuz. So a difficult time to be a central banker at the moment.
Yeah, especially in Japan, with more than 90% of oil imports coming from the Middle East. Of course, this economy is very sensitive to the developments around Iran and, of course, those oil and energy assets. But take a look at how we're setting up for the market opens, because we actually had a day of gains when it comes to the Nikkei stock market, but we're seeing declines of more than 1.5%, both for the Nikkei and the topics. The Japanese yen at that 159 level, very close to that 160 level against the US dollar, which is seen by investors investors as perhaps that intervention threshold. Authorities have already warned that they're very much watching the FX movements here in Japan. We continue to watch the JGB space as well. This, of course, as we're watching fiscal spending in this country, we know that the government is trying to support households with that fuel price cap at a time when we're also contending with geopolitical tensions. We mentioned Iran. We know that Prime Minister Takaichi is meeting President Trump tonight. So what could come out of those discussions will also be key. Do keep an eye on the tech sector, not only just in Japan, but also in South Korea. Micron came out in the overnight session, strong revenue outlook, but it was the concerns about capex that really hit the stock. So we have Samsung Electronics, SK Hynix, and that, of course, operate in South Korea. Hanmi, that gets 20% of the revenue from Micron, that could potentially move in today's session. And you can see the Korean won, that weakness against the U.S. dollar past that 1,500 level already, as the Kospi is now down more than 2.5%, Haidi.
We've been talking about the worsening situation when it comes to the outlook for oil prices, and not just oil, but also LNG and other energy assets as well, right? We are seeing that big jump when it comes to Brent, jumping 2.8% above $110 a barrel as this situation continues to worsen. We've seen major energy assets, some of the most important in that region, being attacked. So it's really raising concerns of a more severe and long-lasting impact from this conflict. We've seen the likes of, for example, Qatari infrastructure, the largest LNG export plants, suffering extensive damage. We'll see that play out through the course of the Asian session there as well. We are also seeing that sell-off across treasuries being resumed. Chair Powell saying that all of this hinges on inflation's path. We also have some breaking news when it comes to HSBC at the moment. The bank is said to be weighing deep job cuts over the coming years. The CEO, Georges Elhedery, is betting on AI to shrink its middle and back office footprint. So we're looking at non-client facing roles in global service sectors as some of those areas most likely to be impacted. The changes potentially impact around 20,000 roles, about 10% of HSBC's global workforce. So we'll continue to bring those details to you on HSBC. That just crossing the Bloomberg now. But let's get back to our next guest, who says oil prices may not come down and that inflation risks are being underappreciated. With us now is Julia Wang, who's a North Asia CIO at Nomura International Wealth Management. Julia, great to have you with us, and it does feel like investors are grappling with this possibility at the moment.
Yeah, sure. Good morning. Thanks for having me. So we think the prevailing market sentiment, I think it's still that, as hopefully the military or the intense part of the military conflict winds down, the oil price will drop immediately back towards $80 or maybe something even below that. Now, we think that if you take stock of what's actually going on in terms of the damages to the oil and gas facilities that you've been talking about this morning, the fact that it's been dragging on for 3 weeks, and the momentum of war is it looks unabated as well. We do think that chances are that as this continues to drag on, then the medium to longer term oil price expectations will start to change as well. And we think that will, given the nature of this oil price shock, is also to do with a shortage rather than, sanctions as it was in the Russia-Ukraine case. We think that the feed through to broader commodities related inflation could also be much broader as well. So we think that there is still an underappreciated a point when it comes to oil price, not today or tomorrow, but when we see that military conflict really dials down what happens to oil price, then I think is what we probably would beg to differ. And I think that would then inform how we think about kind of the investment outlook around this conflict in next few months.
And if you take a look at the gap that we see in trading between Brent and WTI, clearly Asia is taking the brunt of that negative impact. Does that mean you're avoiding risk assets across this part of the region? What's your asset allocation looking like at the moment?
So it's actually still a very complex situation to think through. I think that Obviously, when you have higher oil prices, you mentioned Asia is at the forefront of probably feeling that earlier than the rest of the world. I think it's also at the point of feeling the potential growth stress earlier than the rest of the world. So policymakers here are really grappling with two almost simultaneous development. Clearly, the growth stress is coming through much faster than in prior sort of inflationary or stagflationary episodes. So I think that the next step to think through is actually fiscal policy and how much of room each country has to deal with or to at least buffer household when it comes to the impact of oil prices on consumer spending. And then potentially how much FX depreciation we have to give away when we utilize those fiscal levers or as we push them further in an already very constrained world. And then I think then we have to then finally we can take stock of what the growth outlook is and what that means for asset class. I still do think that there is going to be a lot of policy responses on the fiscal side and maybe some management through the FX. That means that our outlook is more stagflationary, maybe with a higher tail of a more severe growth downturn, but our base case is still more stagflationary, which means that it's unfortunately still a market that you cannot afford to completely miss out on, because there will be assets that perform in a stagflationary environment. And the other important thing, I think, when it comes to Asia growth is that we have secular growth in technology coming through as well. I think that's a very underappreciated growth driver at this point for markets as well.
Talking about stagflation, those concerns really huge here in Japan, especially given that you have the weaker yen to contend with and more than 90% of oil imports are coming from the Middle East. How difficult will the communication be for Bank of Japan Governor Ueda today? Because if you're not careful, you could send the yen over that 160 threshold.
Yeah, I think that the market is already sussing out that this stagflationary impact is bigger for Japan than for many other economies. So the Bank of Japan will have will probably have no option but to fall back to saying, look, this is an additional complication for an already very complex environment. So we'll have to not hike rate. We have to hold and see what happens. The problem is that they were expected to hike either in March or in April, and the probability of an April hike is still 50%, more than 50%. So I think that means that unless Governor Ueda can say something very convincingly reassuring about keeping those rate hike probabilities still on the table, the market is going to probably react take a dovish message out of this, and dollar yen I think have a very high chance of going higher as a result after. So I do think the risk is very much that dollar yen probably will have to go higher after this meeting.
We usually think weaker Japanese yen helping exporters and markets get a lift. Does that still apply? Are there opportunities in Japan when you're contending with all of this macroeconomic backdrop, and on top of that, you have the geopolitical risk coming from the Takaichi Trump summit as well?
So I think that the growth drivers are much more diversified at the moment when it comes compared with a few years ago, and that's something we try to highlight in our 2026 outlook. When we said it's a very multipolar kind of environment. You have technology, which is secular. Japan is involved in upstream of that, and Japan also I think could use technology or AI in its favor to boost productivity growth. I think that imperative grows by the day as the cyclical segment of the economy will be under pressure from high oil prices. There's also, fortunately or unfortunately, the rise in global defense spending that also looks to be secular as well. So there's, I think, other growth drivers, and of course, on top of that, it's the overall export outlook that you mentioned. Typically, does benefit a little bit more from like those machinery sectors, etc. That benefits more from a weaker currency. So I think there's enough growth at the moment that really means that that's to support the overall market outlook at the moment and to support a continued growth in the next couple of months. But I do think that the risk is that some of the cyclical part of the economy probably will be much weaker on the other side of this, and I think that's something the market probably still is yet to reflect.
Julia Wang, really good to have your views. North Asia CIO at Nomura International Wealth Management. And given Julia's comments on that cyclical risk when it comes to the global economy, we have seen the downside pressure when it comes to base metals. And of course, we continue to watch the broader commodity space and very much focus on the oil prices. We could continue to rally. Natural gas prices also jumping as we saw those attacks on a major LNG site in Qatar. Not to mention that we're hearing reports from Qatar that they're dealing right now with a fire at Ras Laffan industrial area. So that is due to a second attack, which had already suffered an extensive damage scenario after Iran really fired at those facilities. Let's discuss what's happening with Bloomberg oil trading reporter Wang Neo. Where are we expecting commodities prices to go, especially the energy space, when the attacks continue? We keep hearing there are alternative routes. We're talking about Venezuelan oil, but is there enough to really arrest this huge surge?
Well, to address this question, of course, firstly, we have to break down the happenings from last night. So the strike on the LNG plant in Qatar isn't simply just a strike. It marks a sort of another step up on escalation in this ongoing conflict in the Middle East, which is now well into its third week. Of course, we have seen prices sort of being jittery over the weekends when the US and Israeli forces had targeted Iran's Karg Island, which was the main island that holds infrastructure for its oil exports. And back then, even though the US had said that they did not touch oil infrastructure, Iran has sent out a message that if that really happens, basically they will go all out and they will be attacking the oil infrastructure of their neighboring countries. And that's what we are seeing that's pretty much unfolding right now overnight as the Israeli-US forces struck an oil and gas field in Iran. Iran has begun to retaliate, and Qatar is just the first of its victims, and we potentially could see the conflict being stretched out. So it does seem like right now oil prices are facing a lot of upwards pressure. We have talked about numerous, I would say, solutions, workarounds to get oil out of the Strait of Hormuz, but let's not forget that this situation is kind of like a sticky situation. The longer this conflict lasts, we will have to spend much more time to unwind the damages or the logistical chokeholds that have accumulated across the course of this conflict.
We're also seeing some reporting on India sending warships to the Gulf of Oman and Arabian Sea to try and ensure safe passage of its vessels. We understand there are oil tankers, LNG vessels there that are currently stuck. We're also seeing the Wall Street Journal reporting that India is buying more than 30 million barrels of stranded Russian oil. Do we see a pretty clear bifurcation of the haves and the have-nots in this situation, where the likes of India, China, the countries that are sort of being allowed to still have passage and access to this oil are going to be doing much better than the rest of the region?
Now, this is a tricky question to handle because even until today, there is no formal, I would say, concessions to allow these so-called allied countries to have safe passage across the strait. Of course, we are seeing countries such as India, whose, I would say, its situation is more dire. It's facing a lot of shortage in terms of domestic heating and cooking gas and all that. So its authorities have been doubling down on trying to get supplies out of the straits. And that's because domestically, they're facing quite a drastic energy crunch. And of course, for the Chinese, we have talked about just in the past week alone, a lot of ships declaring that, hey, we have Chinese crew on board, we're of Chinese origin. This is something that seemed to work for some of these ships. But even until today, it's not so much of a formal agreement as well. So it's pretty much unclear to see how this would unfold. A bifurcation will kind of take some time before we can kind of see it, I would say, manifest itself more concretely.
Our Bloomberg oil trading reporter Wang Neo there with the latest as we continue to monitor these oil headlines. Brent continuing to see that upside over WTI. More ahead on the Asia trade. This is Bloomberg.
The conflict in Iran is showing no signs of abating as Iran and Israel continue to trade strikes on oil facilities. You can see energy prices surging at the moment. The UAE condemning Iran's attacks, while the Saudi foreign minister warned that there will be consequences for its moves. We have seen these prices spike after the world's largest LNG export plant in Qatar suffered, quote, extensive damage. Let's bring in Bloomberg Politics editor Laura Davison and Laura Raslafan, actually seeing a second attack by Iran. What's going on at the moment?
This has, been really a banner day in terms of escalatory attacks, particularly from the Iranian side, coming towards hitting several different sites in the region, particularly energy infrastructure. That's causing a lot of concern. You even have between Israel, the U.S., and some of the allies in the region, some tensions flaring a little bit. The Qatar coming out and saying that it was irresponsible for Israel to make some of these attacks, because they're leading to some of these the retaliation. Particularly this LNG plant in Qatar that was hit that is now suffered extensive damage. It raises just a lot of worries that already the worries that we've seen in the oil markets today of prices rising are just going to continue.
Energy assets under threat, but also, of course, shipping routes. This is a problem with the Strait of Hormuz, but President Trump wants to make perhaps shipping a little bit easier.
Yes. So Trump has rolled out, several different plans. The details, though, have been scant. He said that there would be U.S. naval escorts through that. We haven't really seen that come to fruition, as well as, increased insurance, that the U.S. agency would be willing to back. It's just not clear, though, that anyone is willing to send ships and their people into that because of just the increased risk of everything happening here. We're also seeing, the U.S. is mulling a couple different things, both an increased military budget by about $200 billion. It would be a huge increase. As well as a report just now from Reuters that they're looking at sending thousands more troops to the region, particularly looking at Iranian shores to help secure the Strait of Hormuz. None of these things have been decided yet, but just sort of represent what the U.S. is thinking about and what could be a very long, protracted conflict that involves a lot more money and a lot more people.
We know China has been pushed back for a bit, but it is an extraordinary time to be going through with the Japan-US leadership summit too.
Yes, Trump, is facing a lot on his plate today. And Takaichi is going into a situation here, where tensions are really high. She'll meet with the president, about 11 p.m. Eastern time in 11 a.m. in Washington. She'll sit down with him in the Oval Office. Press will be present there, be able to ask questions. So this conversation could go a lot of different ways. We know when this summit was initially set up, the focus was going to be on U.S.-Japan investments. So there's, plans for Japanese investment into U.S. shipbuilding. This is sort of one of those strategic industries that the U.S. and Japan have decided they want to work together on to act as an effective counter to China. We also expect there will be additional critical mineral and energy deals as well. But of course, Iran is going to hang over this meeting, both, sort of what this means, in terms of the U.S.-Japan relationship. Japan has been pretty clear that they're not going to get involved militarily, but also what this means in terms of economic consequences and economic uncertainty going forward, for several months. We've got, Japan, imports about 90% of its oil from the Middle East. So this is, weighs on no small portion of the Japanese economy.
Bloomberg Politics editor Laura Davison there with the latest. Well, Japanese Prime Minister Takaichi is in Washington for her first visit as the country's leader, facing pressure from President Trump over her government's contribution to the war on Iran. Our Bloomberg Opinion columnist Gerard Arete joins us now for more. So it's, as we were just talking about with Laura, it's such an interesting time to be holding this meeting, right? What are the expectations in terms of how tense these conversations could get?
Well, I think it's a bit of a risk, Typically, these events are very staged, managed. All of the, all of the talking points and everything that's going on are handled beforehand. And obviously, the situation in Iran has made that a little bit more unpredictable. I think some people are afraid of, a White House bust-up of the style that we've seen when other foreign leaders have arrived there before. Personally, I would think that the chances of that would be pretty low. Having said that, the Japanese side are a little bit they've been thrown for a loop a little bit, as we all have, by the situation in the Middle East. This meeting was expected. The reason that this meeting is even happening at all is because President Trump was supposed to go to Beijing early next month, and the Japanese side wanted to make their case to him to avoid being cut out of any potential bilateral deal that might happen when that visit takes place. Now that meeting has been delayed, so even the point of the meeting is a little bit moot, and there's these whipsaw requests for support in opening up the Strait of Hormuz, and then yesterday we saw that request basically being rescinded. So I think from the Japanese side, they're a little bit cautious about what exactly the expectations are going to be from the US side.
What have we seen in past episodes of international conflict on how Japan has dealt with those, especially given its legal and constitutional restraints?
Yeah, Japan is obviously, very tightly bound by what they can actually do in this situation, unlike most of the other U.S. allies who have, rejected or demurred on assisting in reopening the Strait of Hormuz. Japan is really constrained by the pacifist constitution in terms of what it can actually do. Having said that, one of the episodes that lives long in memory here in Tokyo is the Gulf War in the early 90s, when Japan contributed a very large amount of money, $13 billion, if I recall correctly, but was not able to contribute to the multinational force that the U.S. led at the time in Kuwait. That led to Japan being accused of, checkbook diplomacy. The Kuwaiti government famously left Japan out of an ad that they took out in the newspaper, thanking the countries that came to its aid. So Japan is very hesitant to be seen as, as a hanger-on or someone who doesn't contribute, and especially when it comes to the U.S., and I think, even more so when it comes to President Trump. That's why I expect them to find some way in which they can contribute, whether that's in logistics, we've seen refueling, peacekeeping missions, humanitarian aid, something like that. I don't think there will be an outright rejection if indeed President Trump formally requests Japanese assistance in reopening the strait.
Bloomberg's Garth Reedy there. Do check out his column on Prime Minister Takaichi's diplomatic tightrope in the U.S. More ahead. This is Bloomberg.
We do have some breaking news out of how Australia is managing this fuel crisis. Prime Minister Anthony Albanese has announced a new fuel supply task force to coordinate security and supply chain resilience with states and territories. The ex-energy regulator has been appointed to head up this newly created task force. This is Anthea Harris, as a former head of the Australian Energy Regulator and the Energy Security Forum. It sits within the Department of PM and Cabinet. It has already begun operations. So we've heard from Prime Minister Albanese at a press conference following that meeting of the National Cabinet in Hobart. This comes as Australian Treasurer Jim Chalmers warning that inflation could spike above 5% if the war drags on. Living conditions and standards would be affected. Billions from the economy would be wiped out. He's talked about business chiefs moving to a COVID-style posture to avoid supply shocks in the region. Shery.
Yeah, we continue to watch those shipping stocks across Asia as well, given, of course, those concerns around the Middle East and surging oil prices as well. You can see a little bit of a mixed picture there. We have seen President Trump trying to ease transport costs and waiving shipping restrictions. That waiver of the Jones Act will allow foreign flag vessels to transport commodities between the U.S. ports for the next 60 days. We have more ahead on the Asia trade. This is Bloomberg.
We We do have some breaking data when it comes to the labour market here in Australia, just crossing the Bloomberg. The change in employment, seeing almost 49,000 jobs added to the economy. Expectations for 20,000. This is for the period of February. Prior addition was about 17,000 or thereabouts. The unemployment rate ticking a little bit higher, though, 4.3%. Expectations were for 4.1% and markedly higher than the 4.1% that we saw in January. That's a full-time employment change of a loss of over 30,000 jobs and an addition of almost 80,000 jobs in part-time roles as well. The participation rate also ticking a little bit higher there at 66.9%. Well, to one of our top stories today, and HSBC is said to be weighing a wave of deep job cuts over the coming years as the CEO, Georges Elhedery, bets on AI to shrink its middle and back office footprint, I should say. For more on this, let's bring up Bloomberg Finance editor Adam Haig. Adam, what do we know in terms of the strategic ambitions here? HSBC, for a number of years now, has undergone a lot of changes.
It has, Heidi, and really what we're reporting today is kind of the next phase of Elhedery's kind of plans to restructure this bank. And he's since arrived in 2024, of course, been, fairly instrumental in driving massive change across the business. So really what we're looking at now is, potentially a plan that could impact around 20,000 people. So HSBC employs about 210,000 globally. So this is clearly, around 10%, a significant chunk of the workforce. And really, this is an early stage of this planning. That's clear what we're reporting today, and no kind of final decisions have been made. But this will largely impact middle and back office roles, especially in the kind of the global service centres that HSBC has. And clearly this is kind of a ramping up of what he's doing in terms of trying to drive efficiency through various different areas of the bank. And clearly he's been doing that for the last little while since he joined the company, and this is a real ramping up of that.
How's the business been doing so far?
Well, of course, Shery, HSBC has been kind of reflecting some of these huge changes that the CEO is currently undertaking, and the share prices have responded very well to that. And you heard in the earnings last month, a real kind of bringing forward of some of the cost-cutting plans and some of the targets that they're really driving at to increase return on equity for shareholders. And this, you have to see it as a kind of a holistic way to try and continue that drive, really. Clearly cutting costs in its labour force in a very meaningful way is a continuation of a strategy that he began very quickly when he joined in 2024, and this really does drive this one notch higher. I would remind everyone that the plan is in an early stage, so things can change, but clearly impacting about 20,000 people, it's clearly a big push here.
Finance editor Adam Haig there with the latest on HSBC. We're, of course, also watching the tech sector. We had overnight strong results from Micron. The revenue outlook was pretty positive, but it was really that indication of overspending that hit the stock. And we're seeing some broad downside across markets in Asia. And you can see right there Samsung Electronics, SK Hynix taking a hit in the early session as well. We had heard from Bloomberg Intelligence that SK Hynix, Samsung's memory businesses could post gross margin of up to 80% in the first quarter based on Micron's strong results. But we have a down day overall in today's session. We're also having a big day in China. Tech earnings there that we're watching for. Alibaba reporting later. Investors already assessing Tencent's plans to at least double investments in AI this year to more than $5.2 billion. ADRs were down almost 5%. Let's get more with Shawn Yang, Senior Research Analyst at the Red Research. Great to have you with us. First of all, give us your take of Tencent's results, especially when it comes to their strategy around AI.
Sure. I think for Tencent, the good thing is that their core business, gaming, advertising, actually perform very stable. And also that their cloud business, they said that for the full year deliver profits. These are probably some good thing, but I guess that's basically investors have more concerns about its AI plan. Tencent management spend a lot of time talking about their AI strategy and earning, but I guess to some investors they find that the capex spending is lower than the peers, and also seems that Tencent's large language model is still, kind of like under development, and definitely there are a lot of Tencent definitely has a lot of advantages. They have WeChat, they have social network. They hope that that can transfer to their advantages in AI. But I guess that investors probably just in a wait and see mode now. So.
Yeah, so perhaps not surprising that we have seen them scale back their share buybacks this year. Is this an indication of what we might expect from other tech giants as well? Of course, we have Alibaba results too.
Well, I think that I can't make very specific forecast for individual company, but I think it's fair to say probably it's going to be a sector-wide thing. That we have seen that these Chinese internet companies improve their margins for the past couple of years, but now I think they're facing a very big opportunity of AI. Definitely, they want to have more money to spend in capex, spend in advertising. Either AI is seen as a new portal for gaining users, or as a new opportunity to increase the penetration in enterprises. I think to everyone that it's a chance that you can't miss out. So yeah, I think the sector-wide thing that we have already seen some other Chinese companies, internet companies, increase in spending in AI. And I think there will be more people, more companies following that.
So, what was behind the investor reaction then? Is this just a situation where the company continues to outperform, but expectations just ramp up even more?
Yeah, I think it's a good question because investors always ask that. For example, if Tencent increased their capex spending another 50%, what's your takeaway? I think that the key thing is not about the absolute amount of spending. It's about ROI. It's about return of this investment, which means that investors can tolerate about high spending in AI, but they would expect some concrete result. For example, do you have a very advanced large language model can be compared with global peers? Have we seen that your chatbot gaining users, or can we see that your AI related service is ramping up in these enterprises and drive up perhaps your cloud service revenue? So I think this is the key point. Investors would like to see more investment in AI only if this investment can deliver concrete results. I think either in in user number, in revenue, or probably people are talking about the token consumption. But we have to deliver something, something that the investors could see.
Do you think investors will have to practice a bit more patience with Alibaba as well?
I think that's the key difference versus if you compare Tencent with Alibaba, because for Alibaba you can clearly tell that how much they spend in AI and how much the return, because they have a relatively large a cloud service revenue, and and you can tell that, for example, how much your increased spending in AI and how much you return from that, you get return from that part. But I guess for Tencent, the situation is a little bit, kind of embarrassing, is that basically that they choose to integrate AI to each business part. For example, in gaming, advertising, they all have AI, but it's a little bit hard for investors to quantify the AI's impact. But this situation probably is a little bit different in Baba. So, I mean, if you look at Baba, people usually describe Baba as a company with all stack AI capability. So, and people can quantify the AI's return. So I think these companies are probably a little bit different if you look at the AI's investment versus return.
John.
Yeah. Hello?
Shawn, if you take a look at some of the national ambitions from the government that we learnt about from the National People's Congress and the next 5-year plan, which areas of opportunity do you think have popped up for companies like Alibaba and Tencent? Are there sort of new frontier tech spaces that you would be focusing on?
Sure. I think that definitely AI is still the most important thing for these two companies. They have basically they lay out a specific strategy for AI development. And if you look at, I think China's key companies CapEx spending on AI, I think probably Tencent, Alibaba, and probably adding ByteDance, these three top Chinese companies have the highest CapEx spending on AI, and they have user data, they have models, they have GPUs, and they probably will also Alibaba already has a self-developed GPU department called T-Head, so they're going to ramp up in this business, and I think AI is an industry with a lot of potential, and in the future, it can also link to physical worlds like autonomous driving or robots. So yeah, I think that's basically Tencent, Alibaba. I think their key focus will still be AI.
Shawn, always great to chat with you. Shawn Yang, Senior Research Analyst at Arete Research. And subscribers can also turn to the terminal for more on Alibaba's earnings. TLIV Go is your function for the latest updates, plus commentary and analysis from our expert editors. This is Bloomberg. Let's take a look at oil as we continue to see these developments driving, in particular, that gap wider between WTI trading and Brent crude. Brent clearly seeing that outsized impact, which will sort of peter through to what we see as Asia-Pacific economies being hardest hit by the rise in energy costs. And we continue to see the standoff when it comes to the Strait of Hormuz as well, despite some reports, at least unofficially, that some vessels from certain countries seen as, I guess, friendlier to Iran are being allowed through. We're also seeing further developments when it comes to the availability of Russian crude. We've seen a report from the Wall Street Journal saying that India is taking up more of those Russian barrels that are stranded. We are seeing, interestingly, more contingency planning from countries like Australia, the appointment of a fuel supply coordinator, a task force to try and coordinate these risks, given that we have heard from the Australian Prime Minister Anthony Albanese speaking after a national cabinet meeting this morning, and some modelling from the Australian Treasurer looking at the possibility of these COVID-style supply shocks to the economy as a result of the ongoing war. Let's bring in for his views on oil Claudio Galimberti, who's a chief economist at Rystad Energy. Claudio, really great to have you with us, particularly at a time where the news is so fast moving. What do you make of the dynamic at the moment? Because there is a sense that perhaps some of these oil pressures could be more sustained, particularly if we're talking about longer-term damage to energy assets across the Middle East.
Thank you for inviting me. Absolutely. I would say that the war took a turn for a huge escalation at this point with the strike on South Pars this morning, and this a few hours ago, just a counter-strike by Iran on Qatar. So I think that so far what we have seen in these 18 days of war has been primarily logistics constrained. Of course, we have seen some production facility being hit, but in both cases, the damage was not huge. In this case, today, the damage becomes big. And this is a major concern because, as you said, as you correctly pointed out, now the fear is that this may go on for much longer than expected initially, and also coming back once a ceasefire or a peace is reached is going to take longer because now we have physical damage to the infrastructure. And let me just be clear, South Pars is the largest gas field in the world. You have a facility from Qatar, from Shell. It's a major problem. It's a major problem.
Clearly, this is a problem that market pricing at the moment says it's Asia's problem more than it is a domestic US problem, right? Is that the takeaway you get from the gap in pricing between WTI and Brent?
I wouldn't necessarily say that that's a problem for Asia when it comes to oil. When it comes to gas, it is mainly a regional problem because the gas markets is still very much regional. So you see the prices in Europe They are going up tremendously. The prices of gas in the United States, Henry Hub, is still hover around $3.2 per MMBTU, so didn't change that much. That makes perfect sense. When it comes to oil, it is Brent, the international benchmark, the price that everybody looks at because it sets the price pretty much everywhere in the world. Of course, you're going to have some, some differentials depending on the regions when you are, but for the most part, it is Brent. Brent is going up, which means that the price of gasoline in the United States is already above $3.5 per gallon. The price of diesel is already above $5 per gallon. So that will be a problem when it comes to inflation if those prices do not come back very quickly.
We've heard talk about Venezuelan oil. Of course, Russian oil has been given a reprieve as well. Could any of that help supplement the lost supply coming from the Middle East?
In normal market situations, a decision to relieve the sanctions on Venezuela and on Russia, for sure, they would have an impact in the market. And we're talking about maybe $1, $2, $3 per barrel. Right now, what's happening in the Middle East is 1 or 2 order of magnitude larger. So we're talking about since the start of the war, the price of Brent basically doubled. It was around 60 when there was the sentiment that something was going on. It was 70 just before the war started, and that right now it's actually 112. So we're talking about two different phenomenon. And the things that is happening in the Middle East is the largest supply event in the oil and gas market that I have seen in my career, and I started in 2002.
Oh wow. When it comes to transport costs, for example, and just shipping costs, the Strait of Hormuz being closed at the moment, can any of those measures to relieve those costs help? We have seen the waiver of the Jones Act, for example.
It does. This is, of course, in times of extreme crisis like this, you tend to take any possible measure to mitigate the impact on the consumers and on the car user and so on and so forth, and eventually on inflation. But as I said earlier, there is nothing that can compare to what's happening right now. Everything when it comes to the oil and gas markets is a matter of supply and demand. Right now, we have the supply of oil shut in equals to 8.6 million barrels per day. I just give you an idea of what it means. It basically means almost 10% of the total production of oil. There is nothing that can compensate for that apart from starting production again, which hinges on opening up the Strait of Hormuz.
Claudio Galimberti, really good to have you with us, chief economist at Rystad Energy, as we continue to follow the surging oil prices. In fact, Finance Minister Katayama here in Japan talking about that energy subsidy being implemented as an emergency step in order to help households at a time when she's also acknowledging that oil prices are affecting currency trends. She's speaking at the moment as we continue to watch the latest developments in Japan ahead of that Bank of Japan policy decision. A rate hold is expected today. Let's bring in our economy and government editor, Paul Jackson, with what you're watching here in Japan, because we're not necessarily expecting a move from the BOJ, but so much more happening at the moment.
So I think one of the key points today is, can the Bank of Japan deliver some kind of hawkish hold? If you look at January, we had a vote 8-1 and one of the board members proposing a rate hike. So even though they held in January, it looked on the hawkish side. Now, I think they need to at least repeat that today. Otherwise, we could see some sharp movements in the yen. So I think if there's a 9-0 vote and no counter proposal to raise rates, I think we need to be watching that currency chart pretty closely.
The 160 threshold. But then at the same time, I was thinking, nobody necessarily expected that they would move at this meeting, right? Does this sort of give the BOJ a justification, an excuse not to move? Because nobody else can move in this situation, right? In that sense, perhaps a little bit less of a burden to, prop up the yen?
I think that we do need 8-1, and I think we do need a counter proposal to stop the yen moving. Shery, I mean, you're right. You know, would you want to be raising rates at this point? We've got so much uncertainty taking place in the Middle East. How this pans out in the economy over the longer term. I mean, we saw Fed Chief Powell overnight saying, "Hey, look, no one knows the answer to that. They don't know the answer in Japan." But one key difference between Japan and the US is the US is an oil producer, whereas Japan isn't. It's importing, and don't forget 90% of that oil is coming from the Middle East. So how this plays out in prices going forward is obviously going to be a key concern if the conflict is prolonged.
Just super quickly, wage growth, though, staying strong.
Wage growth looking strong at the moment, so that feeds in to the view that the Bank of Japan will keep raising interest rates as long as the Middle East doesn't cause greater confusion.
Bloomberg's Paul Jackson. So much more to talk about, but of course, Paul is very busy today watching the Bank of Japan policy decision coming out in just a couple of hours. So do go to TLIV Go because our expert editors, analysts will be there. That's your function to keep updated on the latest BOJ moves. This is Bloomberg.
Take a look at what we're watching when it comes to what's driving trading in Australia this morning. We had jobs numbers saying unemployment staying relatively low in February. Jobs gains continue, but all of this kind of backing the hawkish RBA stance, if you will. A lot of that drive really coming from part-time roles, though, according to the data that we had, the jobless rate climbing a little bit higher to 4.3%, higher than the forecast 4.1%. So all of this coming 2 days after the RBA delivered its second consecutive rate hike. We also have the RBA's financial stability report as well, really highlighting a good degree of resilience for the Australian financial system, but the risk of a more material adverse shock has increased over recent weeks. So still citing most Australian households and businesses have strong financial positions, but the 4 areas of global risk include the potential for more geopolitical tensions amid the war, macro financial vulnerabilities in China. Shery.
Yeah, which will be very consequential for the South Korean economy as well, right? Take a look at those assets broadly in the red today. And wow, look at the Korean won past that 1,500 level against the US dollar. We're hearing the government, the Bank of Korea, they're all working together to take market steps if necessary. So do watch out for those big moves. And intervention watch is the word of the day, isn't it? That's it from the Asia Trade. The China Show is next. This is Bloomberg.